When the Feds say that they're cutting rates, it doesn't automatically mean that now your rates that you're going to see from lenders on a commercial loan are going to be lower. Probably 10% of banks out there use their own cost of capital. Most lenders have some sort of index, a public index, which they base their rates off of, and they typically add a spread on top of that index. But even if the loan process, you survive that, you have to remember that you're going to be in bed with these guys for the next at least few years. And are they going to be making you crazy once a month to send you financials? We all love that everything goes well and everything should go well on all your properties that you buy, but we always have to know some things just don't go that great. So if things don't go that great, are you dealing with a lender that's a predatory lender, or are you dealing with a lender that is, going to work with you?
When they're going, to 10 different banks, let's say, and they're getting preliminary rates and preliminary terms from each of these banks, and they're deciding on which horse to kind of run with, at what point they should kind of just pick that horse and let the others, go by the wayside, or at least keep them on the hook. Like, what are your suggestions with regards to that process and when you should really kind of jump into one bucket and leave the rest behind?
Great question.
Mobile home parks need good would-be entrepreneurs to get off the sidelines and into the game. My name is Ryan Neris. I started with nothing. No money, no network, and no experience. Over my first decade in the business, I've acquired over 80 mobile home parks spanning 4,500 lots and counting. No matter what level you're at, I can help you get started, scale, and get your business to the next level.
I'm Mike Panzolini. In my 10 years working in private equity, I've managed over 250 mobile home parks. I've spent my entire career in real estate, both personally and professionally, building complex systems and processes and leveraging data and technology to create automations in both acquisitions and operations. I can teach you the methods that the big shops use to professionalize your business.
Together, we will equip you with all the tools, wisdom, and skills that I needed to create and scale a larger business from humble beginnings.
And I'll give you that big private equity shop edge to push your business to the next level, bringing institutional tools to the individual investor. We are the 30-day mobile home park. We're live. Welcome, Judah.
Thank you for having me.
Absolutely. This is, I think, is your third market update. So thanks again for joining us here. So just tell us a little bit about what you're seeing in the market today, where rates are. I know you don't have a crystal ball, and we always kind of start with that disclaimer, but where they might be going based on Fed chatter and whatever else, you have insider knowledge on, if any, or, if you're probably following these things more closely than the rest of us. So in any case, I'll kick it off to you. You can introduce yourself. You can introduce your firm, what you do, and then take it away.
Sure. Firstly, greatly appreciate you having me on, as always. Appreciate the friendship and the relationship that we have and that we're building together. And of course, thanks to Ryan. Shout out Ryan for always having me and having me in mind. And it's always a pleasure. I am the principal of Princeton Capital Group, which is a boutique mortgage brokerage firm focused on MH and RV parks. We've done business in almost all states, so not geographically limited to any specific states. We work primarily with regional banks, national banks, some credit unions, life companies, obviously the agencies, which we'll discuss, Freddie and Fannie, the CMBS market, and then last but not least, some of the debt funds and bridge lenders that we have cultivated great relationships with over the years. We've closed, on average around 100 transactions a year in the MH space in the last 5 or 6 years, and always looking to grow and potentially add value for more clients and try to keep our finger on the pulse of where lenders are at, which lenders are in, which lenders are getting aggressive, obviously monitoring rates and all of that, but more so, as Michael mentioned, it's a little bit tough. The crystal ball has yet to arrive in my office. So it's tough for me to know where rates are going to go, but it's more, where are they today? Which banks are quoting aggressively? Which banks are using which indexes, which is super important, which we'll get to as well. So that's kind of the little background on who I am and who we are as a firm. And we've been lucky enough arrange financing for a number of individuals that are here on this call, and obviously for Ryan and Michael personally as well. Just to give you a little bit of, I guess, an update starting from rates. So obviously the number one thing that is on everyone's mind is where rates are going. Where are rates today? Are rates better? Are they getting better? What can I underwrite to as far as rates? And even though there are a lot of other pieces in the puzzle of financing when it comes to the debt terms, whether it's the amortization, whether it's the LTV, whether it's a lender that's easy to work with or difficult to work with, there's a lot more that's not written on a term sheet or on a loan paper that you're going to get from a bank that, we try to help and guide clients of, hey, this bank looks like they're offering a lot more aggressive, but we've had experience with them. And when all is said and done, you're going to be going through a colonoscopy. And by the time you're done, you would have jumped at the lender that was offering you, $20,000 less in your loan proceeds. But to talk to rates. So obviously there was a lot of talk about the Feds cutting rates, and without getting into too much politics of our great president's internal fights with those at the federal level, at the end of the day, there were a few rate cuts last year. And I would say towards the middle of last year, they were projecting that in 2026, there will be a number of rate cuts coming. Now, two things to understand about that is that when the Feds say that they're cutting rates, it doesn't automatically mean that now your rates that you're going to see from lenders on a commercial loan are going to be lower. It depends what index that lender uses when they tell you their rates. So there are some banks that just have an internal cost of capital, which is not tied to any indexes. It's not tied to the Treasury. It's not tied to Prime. It's not tied to SOFR. It's just internally how much they have to make and how much they're offering on deposits to their customers and how busy they are. But those are, I would say, the number quite a few, but only a few. I would say probably 10% of banks out there use their own cost of capital. Most lenders have some sort of index, a public index, which they base their rates off of, and they typically add a spread on top of that index. So we'll go with the most popular one, at least in the last few years, which is used from the agencies to CMBS to most of the larger national banks and even a lot of the regional banks. They go based off of the 5-year or the 7-year or the 10-year US Treasury bonds. And, depending if you're taking a 5-year fixed or a 7-year fixed or a 10-year fixed, that's what they'll base it off of. And then they add a spread on top of that. So for simplicity's sake, you have today the 5-year US Treasury is sitting at 3.8. So it's kind of ticked up a little bit in the last few weeks. And lenders will say, well, we'll offer you a 200 spread on top of the 5-year Treasury, which means that your all-in rate is 5.8, right? I would say most of the agency loans, depending on the size of the loan, are probably in that realm of 200 over. Most banks are probably 250 to 300 over, which translates into 6.25, from 6.5 to 6.8, right? There are some banks that are even higher than that, but let's, just assume that for now. Now, what's happened is when the Feds come out and say they're cutting rates, they're not cutting the Treasury bonds. Treasury bonds are public bonds. It's based on investors and investors' view of the market. So what investors look at more than the actual rate cut itself is what does the market look like? Like Treasury bonds have gone more on a roller coaster, not from rate cuts by the Fed, but rather from the reports that the Fed is basing their rate cuts on. So whether it's the employment numbers that come out, unemployment numbers that come out, or jobs reports that come out, that is going to affect the Treasury bonds a lot more than what the Fed is going to actually do. Another thing is a lot comes into play is to what he says, the Fed chair, when he gets up there. If he says, oh my God, things are looking, fantastic, and we're going to cut rates and we're looking to cut rates aggressively, even before he actually cuts the rates, you'll see Treasury take a nosedive. So what happens is that now, since over the last few months, the Fed chair seems to be indicating that they're not going to be cutting rates that aggressively, and maybe one or two are coming in 2026. The Treasury bonds started spiking back up. So even though we reached a point where the 5-year Treasury was down to like 3.5 a couple of months ago, now, as you see, it's already up to 3.8. And I think it even hit 3.9 a couple of days ago. So it's very tough to say where rates are going to go if you're dealing with all those lenders that are basing their rates off of Treasury. However, on the positive note, since I don't want to just be all doom and gloom about rates, we are seeing banks that are saying, okay, we need to use the Treasury as our index, but because we're not doing that many loans, the market's more sluggish, we're losing loans to other banks that are going to use other indexes, which I'll talk to in a second. Some of those banks are now cutting their spread over that Treasury. So from the agencies to CMBS to regional and national banks, we're seeing it across the board. Spreads have come down significantly. So the same agency bank, Freddie and Fannie, that were using, a 200 spread over that 5-year Treasury. Now the Treasury has spiked up. We're starting to see them say, okay, we're getting more aggressive on our investor spreads, and we can do it at a 150 spread. So even though Treasury went up 30 basis points, but because they cut their spread over Treasury by 50 basis points, net, you're in a gain of 20 basis points. Same thing for some of the other banks that we deal with. One of the large banks that we deal with, they were quoting 350 spreads for a while, and they came down to 325, kind of recently at 300. And in a recent conversation that I had with them last week, they said, just seeing where loans are coming off their books, they need to do more business, they need to be making more money for their depositors, they're looking to cut spreads down to 250. So that's a great example of a bank that is realizing that as much as Treasury might not be going in our favor, we need to be doing something to bring rates down to a reasonable level. Do I think that we're going to hit rates again of the 4s? I don't think that that's coming for us in 2026, unfortunately. Towards the end of 2025, we closed a few agency loans in the high 4s, for larger agency deals that were, we caught Treasury sitting at 350 or 360, and we got a 170 spread, or a 150 spread. That's where we managed to quickly catch it below that 5% by a drop. But I have a feeling that we're going to be, outside of the agencies, I think most banks are going to probably aggressively be quoting in the low 5s, and more realistically mid to high 5s, I think, is where we're going to sit. That's the little bit of crystals that I've had for breakfast. That's the story on rates. Now, just to speak to the other indexes. So when the Feds do cut rates, what are they actually cutting? They're cutting the cost of funds for banks, for anyone that borrows from the Fed. So banks that use prime or they use SOFR as their index that they lend off of, those banks you're starting to see lower rates on, because prime has come down from 8.5 to, I think today, 6.5 or 6.75. So if a bank lends off of just straight prime with no spread on top of prime, so yes, a year and a half ago, those banks were not seeing any deals because their rate was 8.5%, or then a year ago it was still 8%, but a half a year ago it was at 7.5%, and today they're already at 6.75. So they are at times now starting to win deals again over other banks. And even if the Feds only cut rates another 2 times in 2026, if a bank uses prime, they're going to be at 6.25. Similar thing what's going on with SOFR, which is the secured overnight federal rate. That's literally what the Feds are cutting. You see SOFR, you use an average SOFR of 30-day SOFR, but that's been coming down tremendously, which is most popular, I would say, by the bridge lenders to use SOFR. So We saw bridge loans being done in 2021 or in 2020 at 4.5% interest rates on bridge debt. And how was that possible? SOFR was in the ground. SOFR was at 0.5. So if a lender lent at 400 over SOFR, his rate was still 4.5%. Then SOFR went all the way up, and now SOFR is starting to come back down with all these Fed cuts. So now bridge debt is getting more affordable. Now you can have a bridge lender that's lending at 300 over SOFR. If SOFR is at 3.65 today, you can have a bridge loan done at 6.65, which is kind of crazy, because if you have a bank that's lending still at 300 over the Treasury, that bank is lending at 6.8, and I could go to a bridge lender and get 6.6. However, obviously, bridge debt is a little more, risky in a way. It's shorter term. You don't know if SOFR is going to start ticking back up. So that kind of is a little bit more of why it's not necessarily more attractive, but for a lot of deals that we would have been doing, 6 months ago, all day long with a bank, now suddenly those deals we're analyzing and looking at them and sending them to some of these bridge lenders, especially if the borrower's business plan is to refi in year 2 or year 3, and they're super confident in their business plan. And even if it's a cash flowing deal today that works for 70-75% from a bank, sometimes it makes sense to just go with one of these bridge lenders that will be at that same 70-75. Sometimes will be at even an 80% LTV and be at a better rate. So that's kind of what has happened, I guess, as of most recent. That's to me the most interesting part of where we're at in the cycle with rates, is that you can have a lot of deals that someone would have laughed at me if I said, oh, why don't you go bridge on this deal? And they'd be like, why would I go bridge at 8% if I could get a bank at 6.5%? And now the conversation is, do you want bridge debt at 6.5% versus a bank at 6.6, and have the flexibility to refinance whenever you want, have a higher LTV and less scrutiny and an easier process? I'm not saying it's a fit for every single deal. The bridge lenders in our space are limited. It's not like in the multifamily space where you have 500 lenders trying to do bridge loans. In the mobile home park space, there's probably 15 or 20 that we trust and we've done business with, and they typically like the larger deals. But it's definitely something to think about when you're looking at new deals. And to Richard's point, you can always buy a cap. They not only can you buy a cap, most lenders will require you to buy what they call a rate cap, is to ensure that if SOFR, for whatever reason, would suddenly flip around and start going the other way, you're not letting your rate run away from you, because the lender requires you typically to buy a rate cap, which caps SOFR at a certain amount. You typically might not want to cap SOFR where it is today, but you might cap SOFR at, a quarter of a point or, 50 basis points above where it is today, to protect yourself in case SOFR starts going the other direction. So that's kind of a little bit of an insight on where rates are today and where I think they might be going, and what might make more sense based on the different indexes, which is super frustrating. I had a client who I will not name, but understandably was frustrated. We had a closing at the end of December, and when it came time for closing, Treasury had spiked up, and his total rate, we were going with a bank that was using 300 over, and his total rate was close to 6.9. I think it was like 6.8 something, which is still good, but he was used to using banks that use prime, which a year ago prime wasn't attractive at all. But today he opens up his computer and sees that prime's at 6.75. Judah, why did we go with a lender that's now at 6.8 or almost 6.9 if I could have gotten 6.75? So it definitely, it's worth exploring the other lenders that use some other indexes outside of Treasury if they're not going to start cutting their spreads over Treasury, as we discussed. I guess one thing just to round out on that point is that there is, as I mentioned in the beginning, there are so many other factors that go into choosing a lender for your deal. Obviously, there's rate, but there's also what DSCR does your lender require. So you have some lenders that require a minimum debt service coverage ratio of 1.25. There are lenders that require 1.3. There are lenders that require 1.35. So you might have a lender that has a better rate, but because of their higher requirement for your debt service coverage ratio, they're going to come out with less proceeds at your closing table than the lender that's slightly higher on rate that uses a lower debt service coverage ratio. Same thing would apply to amortization. So we know that typically all commercial loans are amortized over a lengthier period of time than your fixed rate period of that loan. So when you go for a commercial loan, you'll get a fixed rate for 5 years or 10 years, but it's amortized not over that 5 or 10 years because your payments would be, enormous. But rather it's amortized typically over either 20-year AM, which is more popular by the local banks, 25-year AM, which is more popular by some of the smaller regional banks, and a 30-year amortization by the larger national banks, agency, CMBS. So putting that in perspective, again, you could have two lenders that come back on the same deal. One of them is quoting a 6% rate, but they're on a 25-year amortization, versus another bank that comes back at 6.5% rate, but they're on a 30-year amortization. What could happen is that because the bank that's using a 30-year amortization, they're able to then have more room on the debt service coverage, which allows them to hit higher proceeds even with that higher rate. But B, for you as a buyer, when you plug in those numbers into your pro forma and trying to show your investors your cash on cash, your IRR, that number, even with a higher rate, might look a lot better because of A, the higher leverage, but B, more importantly, the longer amortization. So that's why it's not all about rates. There's obviously other things that come into play. And then we always say that the biggest thing that comes into play is not what's written on the term sheet. The biggest thing that comes into play is who am I getting into bed with? At the end of the day, the lender is not only a partner, he's the biggest boy in the room once you close on that deal. The investors that you're busy bending over backwards for and trying to get them on board for $100,000 or a $50,000 check, you're willing to really spend the time and kind of do whatever you can to make those investors happy. You have to realize that 70% of the stack or 75% of the stack of capital is being provided by your debt lender. So it's not only a partner, he's the biggest partner you're going to have. And as much as when you're looking at taking LP investor money, you wouldn't take it from someone that would call you day and night and ask you for an updated rent roll every single day on the property. You also don't want to get into a situation where you went with a lender that doesn't only have LP money in this property, they have typically your personal guarantee, and they've lent 70 to 75% of your purchase price, and they're going to be asking you for daily rent rolls. Obviously, that's an exaggeration, but there's a big piece of the puzzle that a lot of, especially guys getting into the business, miss, which is it looks super attractive on paper, but the loan process itself can be brutal. But even if the loan process, you survive that, you have to remember that you're going to be, in bed with these guys for the next at least, few years. And are they going to be making you crazy once a month to send you financials? Are they going to make you crazy if, we all love that everything goes well and everything should go well on all your properties that you buy, but we always have to know some things just don't go that great. So if things don't go that great, are you dealing with a lender that's a predatory lender, or are you dealing with a lender that is, going to work with you, that's going to understand the story? If you have tenants that suddenly start moving out of the park and this, lender number one, you sent them an updated rent roll and they were like, oh my God, what happened, Michael? And you say, well, I don't know. There was some bad tenants. We got them out, but we're working on improving occupancy. And they're like, go, Michael. We love that. We love to hear that. And you're doing a great job. We'll be with you. And we'll, as long as you're making your loan payments, we're happy. But lender number two, they see an updated rent roll and suddenly they're starting to slap on, cash restrictions and hitting you with other things and making you crazy. So there's a lot more that goes into play. Choosing a lender is an important piece of the puzzle. I think that's it.
That was fantastic. Yeah. And I'll stop you there and I don't know if we want to dive into specifics of, who you're seeing currently as the best partners and the best types of lenders. We can discuss that as well, but I will stop there and I'll open the floor to questions about everything we just heard. I've been writing some notes here for everyone who's joined a little bit late and if they want to review them, but we're happy to bring whoever would like to come to the stage to ask a question. You can bring a potential deal that you have right now for some quick feedback. And maybe we can all learn from those case studies. Or we can just kind of continue on with Judah and let him talk about a little bit about each of the different lenders and what we're seeing with each of those lender types. I got a question. Okay, Deck, I'll bring you to the stage.
Hey,
I
guys.
think I know what this one's about. So I'll provide any additional context that you don't give, Deckel. Go ahead.
All right. Okay. So, hi,
Yeah,
Judah.
Deckel.
How are you?
Good.
Good. So I have a question. It's a little bit different than what is that, but it's regarding a master lease. So my question for you, have you ever done any master leases? And if you did, are you aware, I don't know, obviously it's not a legal advice or anything, but if you're aware of any issues that could have come up when someone is going to do a refi or a purchase after that, considering that the person who's doing that wasn't the owner, right? He was just renting the property. If that's going to affect anything with doing this structure compared to if it was a seller financing, and then basically going to the bank after that and asking, hey, we wanna now get a refinance, or we wanna now get a loan after everything is done. Is this going to affect that? Is this going to affect the credibility of the seller too, of the buyer, sorry, which, put it all the time and money into that? So are there any maybe complications that could happen from doing a structure like that? And I know there's also might be complications for tax benefits, but that's another question. So I'd love to hear what you think about a master lease option.
Sure. Give me, if you don't mind, just that way it makes it easier for me to answer it with real numbers and for everybody here on the call to understand what we're talking about. Give me it doesn't have to be exact numbers, but what would be the master lease payments? How long is the master lease for? And then is there a balloon payment at time of, purchase post master lease? And, give me kind of some of what those numbers are, just estimates.
Okay, so like 1.2, let's call it 1.2 million purchase, and then you have 200 that will be paid at the closing, okay? And then the payment will be 4%, 5%, and 6%, term for 3 years, and then the balloon is due after 3 years. So the $1 million will be due at the end of the term. And the 4%
during the time of the master lease, you're paying that escalation on that rate is on the full 1.2, or is that on the
one? So on the one, yeah. So that'll be on the one. So that'll be 40 grand, 50 grand, and 60 grand IO.
Great question. So to answer your question, it is something that we've encountered. Obviously, I think in the mobile home park space, there's very little we haven't. There's many different structures that people try to do in order to get deals done, and some of them are easier than others to then refinance out of. So that is a great question. I would say there's two ways that banks look at this, and I would preface by saying that there's when I say two banks, I don't mean just two banks, two groups of banks that will look at it like this. And one way to look at it is that they'll just simply look at this as a regular straightforward purchase, that you bought this park for 1.2 million and you bought it, now, right? But the payments for that purchase just happen over time. And it's as if the lender, almost like a seller note, but even though understanding it's not structured as a seller note, but the same way they would look at a seller note, which would mean that in a case where you need to go to a lender in 3 years from now, when your $1 million is due, so they're not going to say, oh, we'll only lend you 70% of that $1 million, thereby only giving you $700,000, because you need to come up with $1 million. So they'll say, no, we understand that you gave $200,000 already up front, and you've paid in to this deal all the interest. And what they'll do is they'll calculate the 200,000 plus all the interest that you paid, plus the million, and give you 70 or 75% of that full stack. That I would say is the most popular and the most reasonable way of looking at it. For them to look at it that you bought the park for 1.2 million already 3 years ago. Like sometimes I have that question where people are like, well, no, I really bought the park already 3 years ago for 1.2 million. And now I just want 70% of, the value today. So if I get an appraisal that shows this park now, because I worked my back off to get this park now to be worth 3 million, I want 70% of 3 million, and I want to kind of make money at the closing table. I can't say that's impossible. There might be some local banks that will perceive it that way and look at it that way, and therefore, you would be in a position where you literally walk to the closing table and walk away with equity. But I would say that's not something we've done, not something we've seen. So again, most of the banks are going to look at it the way that I described. So I didn't run the exact calculations, but assuming the full stack is going to be your 1,200,000 plus whatever you paid in interest over those 3 years, which let's call it brings you to 1.4 million, and they'll give you 70 or 75% of that, which again is not going to be a million, but it will be pretty close so that you don't have to come up with that much equity at your ultimate closing at the end of that master lease. However, there's another group of banks out there that will not count those interest payments as part of your capital stack, so to speak. They're going to see, okay, there's a purchase contract here. The purchase contract was a staggered contract where you only had a master lease, but you're ultimately only taking control of the property. Deed is only getting transferred today. So how much is it costing you to get that deed transferred? It's costing you $1.2 million, 200,000 of which you've already paid. But at the end of the day, the purchase price is only 1.2. We're only going to give you 70 or 75% of that 1.2. So if you want to be really conservative, underwrite with the latter. If you want to be kind of, not too aggressive, because it's very, very achievable, I would say you can underwrite with the way that I started out with. If you want to be really aggressive and hope that you're going to get a bridge, whether it's a bridge lender at that point or a local bank at that point to just use today's value, then that's definitely a route you can take. Now, speaking to bridge lenders, though, I've done that a number of times with a bridge lender that understands the whole story, understands that Deckel has worked for 3 years at this park, raising occupancy, raising rents. The park is now worth $3 million. He's getting a steal of a deal because of the way he structured it at $1.2 million. Then they would give you, maybe not 75%, because they see that it might be tough for you to get them out at that level, but they might give you 65 or, close to that on today's value. So if you manage to get the value all the way up to $3 million, then going with a bridge lender might be the answer at that point in time.
Got it. Okay, great information. And what about, that will be different between that and seller financing, right? Seller financing would be acting a completely different way, just more of a standard refinance, correct?
Correct. As long as it's structured in the way of a genuine seller financing. But that we've seen times where borrowers came to us and said, yeah, I did seller financing. And then I'm like, okay, great. And we start the whole process and the bank asks for the title report and they see there was actually no transfer of deed and nothing really happened 3 years ago other than simply almost like a master lease was put into place. But if it's a genuine seller finance deal, then they'll look at, today's value, as long as enough time has transpired since purchase where they won't use your purchase price anymore.
I see. Yeah. So that's the biggest thing here. The difference between the two is, on one, they're going to look at the today's value, which will be in seller financing if structured correctly. And the other way, with the master lease, they will most of them will look at the 1.2 million, which is the value for where I entered that. And they wouldn't even take into consideration that I maybe poured 300 or 400,000 into that property.
So if you personally put in money from your own pocket for capital improvements at the park, then they can count that as well.
My own pocket or an investor money, right? would be the same.
Yeah, same thing. I mean, if you bought it for 1.2 and then, you put in, $300,000 in improvements, and then you had another $100,000 of those interest payments that you paid to the seller. So your basis in the deal is called 1.6. Then, then potentially, you can walk out also with recouping some of that money at closing by getting a loan of, 1.1 or 1.2 at that point.
Got it. Okay. Michael, is this good for us, or you have anything else to say here?
No, and just so everyone's aware, Declan and I are working on this together. I'm not coming in as an LP or a GP, but I'm assisting Declan. He's in our mentorship program. So thanks for asking the question, Declan. This was incredibly illuminating. We've received different answers, and I like this one. I like this answer, so that's good to hear.
Yeah,
these can be complex to structure, and so it's good to hear that most lenders just kind of look at it along the same lines they would an acquisition effectively. Thank you for the question, Declan. Thank you for the answer, Judah. If there aren't any other questions, I'll hand it back over to Judah. I do have one question. And the first part of the question, Judah, is I know your team deals with large loans at this point. What is the minimum loan value that you're typically looking at for our listeners who are coming to you with potential deals? And I know, if it's close to that amount, you may have associates that can help out as well. But what typically are you looking for in terms of minimum loan value for your clients?
It's tough to say because typically the minimum loan size is probably $1 million, right? Most of the regional banks, that's their minimum. But, and even at that million, you kind of went out of the bucket of some of the really large national banks. The national banks, typically there's probably 2 to 3 million. CMBS is usually 3 million. Agency is typically around 2 to 3 million. But as far as, from our end, I would love to work on every deal. It's just a matter of, okay, the banks that we have relationships with, typically the answer is $1 million. However, I closed a loan, I think it was last week, for a repeating client that had done already a few deals with a certain bank that we introduced them to, and we did a $450,000 loan. As far as bringing a first deal to the table to a potential lender, that number is probably around $1 million. But
Perfect.
down the line, or especially if you have, even if you might not have done deals with that specific lender, but you showing, hey, I'm partnering with Ryan, and Ryan is able to show that he owns, 1,700 mobile home parks. Obviously, you're going to get a different answer from those lenders that they'll make an exception there.
Great. And the reason I teed you up for that question was the follow-up, which is, first of all, if you do have a loan that you need some help underwriting, and you might need Judah's help or Judah's team's help in finding a lender for, definitely reach out to him and he'll work on them on a case-by-case basis. Obviously, the larger the loan, the easier it will be for them to get you a lender. But definitely, after this call, you'll receive a link and you can easily reach out to Judah to talk about your specific situation. That said, for those of us who are working on smaller deals and we're shopping loans from credit unions, local banks, et cetera, I think one of the challenges that I've faced and that I've heard my students face multiple times is when they're going, to 10 different banks, let's say, and they're getting preliminary rates and preliminary terms from each of these banks. And they're deciding on which horse to kind of run with, at what point they should kind of just pick that horse and let the others, go by the wayside, or at least keep them on the hook. Like, what are your suggestions with regards to that process and when you should really kind of jump into one bucket and leave the rest behind?
Great question. That's something that I deal with on a daily. We have a lot of times we'll send out a deal to call it 10 lenders. And as you can imagine, the list of the 10 lenders is after filtering out internally, knowing, okay, we have a list of 50 lenders we could send this to, but these 10, their rates are going to be too high. These 10, doesn't fit the business plan. And so we narrowed it down to 10. We're expecting them to pretty much come in close to each other. And a lot of times they do. And you'll have the top 5 banks are really neck and neck. So part of what makes us choose one horse over the other is we'll discuss the pros and cons with the client, obviously. But I would say depending on how much time you have, right, you might want to do a little more due diligence into a lender before partnering up with them. As weird as that might sound, like going back to my point before, you're partnering with these guys. You want to at least, it's not a weird question to ask them, hey, not only to ask, have you financed mobile home parks before, which that should be the first question, but once you get terms and rates, you should ask them, do you mind sharing 2 or 3 referrals of clients that you've closed a mobile home park with? And if the lender says, sorry, we're not at liberty to do that, that should be red flag number 1. Typically, a lender will be totally okay with saying, yes, sure, let me reach out to a couple of our clients that we've closed for, or it's a mortgage broker or whoever that can vouch for this lender. I think that that's super, super important. But once you get comfortable with a lender, and assuming that it's a lender that's the most aggressive or fits the business plan the best, I would still keep, as Michael said, the other ones warm, but be very upfront with them and say, hey, we appreciate the time. We appreciate the quote that you gave us. It was super attractive. And it honestly, if not for bank XYZ, whether you want to name the bank or not, without naming the name, you can just say another bank came through with, something that fits our plan a little bit better or slightly more aggressive. However, we will definitely circle back to you if things don't pan out as planned. That way, you're being respectful. You are keeping them kind of warm and telling them, hey, bear with us for the next couple of weeks, because we might need to circle back and ditch the horse that we are ultimately right now deciding to ride with.
Thank you, Judah. That was a great explanation. I brought Kyle to the stage here. He has a question. Go ahead, Kyle.
Hey, Judah. So quick question. If you are going agency, is there like a percentage of homes that a Lonnie dealer can own in the park?
Great question. 20% is the official metric. However, we've seen both worse and better. So I would say we've seen times where, for an experienced agency borrower and someone that they liked and a stable deal that it didn't have too much here on it, and everything else about the park was great, the quality, and there were no other waivers that we were requesting. We were able to get even, I think it was up to 30% that was owned technically by a Lonnie dealer. Like, there was 30% park-owned homes, which was our only waiver we were going in for. And all of those 30% were owned by one gentleman, and we got that approved. But on the flip side, we've had scenarios where we went in for first-time agency borrowers where agency was like, yeah, we technically could give you the waiver up to 20% for the Lonnie dealer, but we're not comfortable with more than 5%, given that, the borrower is a Leo, which is their term for, a new borrower, and therefore we don't want to make any exceptions. So the agencies have been kind of friendly, but at the same time getting a little more picky, and especially when it comes to some of the waivers that they were giving out. Towards the end of last year, Fannie made a grand announcement that we are not granting any waivers for deals under 10 million, which meant if you had a park that was only 88% occupied, which used to be an easy waiver to get because it was slightly below 90%, they weren't doing that anymore. So it's kind of tricky to know exactly, because it's going to depend on A, who the borrower is, B, what the park, what the rest of the park looks like. Are there other waivers that we're going to need to be going into Fannie or Freddie for? But C, just as importantly, might be who the borrower is. Do they have agency experience, or is this their first rodeo with them?
Got it. Thank you. Hey, one quick follow-up question. How long do rents need to season if you just have done a rate increase?
For the agencies?
Yes, for agency.
You can close as soon as typically T1 collections come in. So as soon as, if you raised rents effective March 1st, as long as you're able to show all those rents came in at those proposed increases, you can close immediately thereafter. Immediately meaning, just to put it into real figures, assuming March 1st the rent increase goes into place, you probably give it to the 25th or 26th to allow for everyone, and even the late payers, to pay. You then go with that to your dust lender that you're going to be dealing with to then go in for final approval. Assuming that that's the case, you probably look at, March 1st rent increase. You can close with those rent increase figures probably first week of April.
Awesome. All right. Thank you.
Yeah.
Thanks for the question, Kyle. We have two other questions here. We'll start with Ryan Tees. I don't know if you can see the chat here, Judah, but he says, are there any differences in rates or spreads for refinancing following a cash purchase, say after 6 months to 1 year of operations post-closing?
Sure. So typically within a year, most lenders look at the loan as almost like an acquisition financing. Even though it's not acquisition financing, but within a year they look at it as acquisition financing, which is for good and for bad. For good that the rates will probably be similar to acquisition financing, but for bad that they're not going to credit you with where the value might be today. They'll look at what your purchase price was. But to answer the question, if it's a refinance, 2-3 years down the line, depending if it's a complete cash out refinance versus, maybe still having some skin in the game, and depending on the lender. So, for example, one of the most popular cash out refinance lenders today is going to be CMBS. And, especially once you're fully cashing out, you're putting this thing to bed. But CMBS prices their loans. Fitch will come in and say, hey, if there's a complete cash out above the basis, your rate is 275 over the Treasury. If there's still some skin in the game, it might be 250. So, in an acquisition financing, it might be 250 or 245. So there could be some differences with some banks. Some banks, there's no difference at all. And depending on the length of ownership before that refi happens might come into play as well.
Awesome. The next question is from Adam Petriella. 21st Mortgage has homes financed. If I buy a park, how does the lender look at the 21st Mortgage debt if the current owner wants to keep the units after I buy it, or if I assume those loans and take title? I guess it's a two-part question there. So yeah, go ahead.
So if the current owner, we'll start with that. If the current owner is keeping the units after you buy it, so that circles back to kind of Kyle's Lonnie dealer question, because that's in essence what the lender is going to look at when they see that you're buying a park, but yet all the homes at the park are going to be owned by one person, an individual that is not beholden to them. So that might just in general scare some lenders off, depending on what that percentage is and how many homes we're talking about. So you just have to be careful there to understand which lender you're dealing with and what is their sensitivity to a Lonnie dealer owning a certain percentage. I don't know what that percentage is of homes in the park, but assuming that it is a lender that's okay with it, or if it's not that many homes, then the lender is going to, if the current owner still keeps the units, I'm assuming the current owner is going to pay the 21st Mortgage debt. So that's neither here nor there for the current lender. But if the owner is not going to keep those units, so you're going to be taking over those units and the liabilities associated with those units, the lender looks at it. So there's two parts to that too. The lender looking at it from a perspective of what your purchase price really is for that park is the first thing. Because if you're buying a park for $1 million and out of that $1 million, there's really 5 homes that you're assuming debt on. So they're going to say, okay, the debt is 90% or 80%. They're going to want to see those agreements to see now how much we allocate out of this $1 million purchase price towards these homes. Even though you're taking on debt, you're not taking on debt of 100% of the value of the homes. So they might then discount your purchase price and say your purchase price is not $1 million for this park. It's $1 million. It's $1 million for the park and the homes. Once I take out the homes, it's only $900,000, and we're going to give you less on your purchase price. So that's the first thing to just understand the way a lender might look at that. So it does help you that you're assuming the debt, right? Because if you were buying a park that has those same 10 homes and and those homes have 0 debt on it, then a lender is going to say, well, okay, out of your $1 million, really $250,000, because $25,000 per home is what you're paying, and therefore your purchase price is really only $750. So taking on the debt, if anything, is an advantage, not a disadvantage. But as far as the underwriting piece goes, there are some lenders that want us, even if they are lending on just the park, not taking the homes as collateral, they still want to see the global picture. So even even though they typically won't ask you for the home rents to be able to count it towards their debt service coverage, but they will ask you for the home rents and those loan payments and your expected expenses on the homes to then say, okay, the park was doing great, but now that you're taking on all that debt, now suddenly you're going to be underwater if you take as high of a loan as you wanted from us. So, that's a long-winded answer. I hope that answered your question, Adam.
Next question from Ryan O'Callaghan, or O'Callaghan, I hope I pronounced that correctly. What are the different waivers that lenders will have typically?
Assuming he's referring to the waivers that agency lenders would need. So as we all know, agency, Freddie and Fannie are the most stringent of all lenders when it comes to park quality and sponsorship profile. So they want to typically see, we'll start with the sponsor side. They want to see someone that has been managing and owned mobile home parks for more than 2 years. And they want to see a sponsor that has a net worth equal to the loan amount being requested and liquidity equal to 10% of the loan amount being requested. So there are waivers that can be obtained there where, okay, I don't own a mobile home park for 2 years, but I was managing Michael's mobile home park for 2 years. And I have experience with management, and Michael's going to actually be helping me manage this park, even though he's not an owner. There's a waiver to be obtained there, which can sometimes help some of those first-time buyers. Or I wasn't a GP, I wasn't a general partner in any mobile home parks, but I've been a limited partner in the last 10 years in so many deals, and I'm going to bring on, Blink Management Company. Oh, I didn't even mean it like that. I meant Blink Management Company to manage the park. I guess shout out to Blink, and get the agencies comfortable there. The other thing would be the property condition stuff with the agencies, which they typically want to see, a 5-star park or a 4-star park with fully paved roads and, sidewalks and all the homes being skirted and hitches removed. So there are waivers you can go in for that and say, the roads are paved, but I don't have sidewalks or even curbs, but I'll put in curbs post-closing. I don't have all the homes skirted. 80% of the homes are skirted. I'll finish the skirting after closing. There might not be any amenities, and all the other parks in the area have amenities. I plan on putting in a playground or, whatever, hold back some money. So there are some waivers you could go in on that. Agency has occupancy and POH percentages as far as, they want to see a park that's 90% occupied, and they want to see a park that doesn't have more than 25% park-owned homes on a refi and 35% on a purchase. You can go in for waivers on that. My park is 37% park-owned homes, or my park is only 88% or 85% occupied. There are waivers you can go on for that. However, understandably, you can't go into Fannie and say, I'm buying my first park, I'm going to be managing it for somebody else. There's no skirting, and there's too many park-owned homes, and my occupancy is at 85%. I want all those waivers. Obviously, you're going to get shut down. It's a matter of managing the agencies and showing them that, no, everything else checks the box. I just need 1 or 2 waivers. But those are the waivers that are potentially available.
Great. I don't see any other questions coming through. So if that's all, I'll give you the stage, Judah, if there's anything else you wanted to close on, and then, talk about how people can reach out to you and what the process looks like.
Yeah, sure. So I would say just to talk to some of the popular avenues that people are using today outside of what we discussed before with the bridge lenders getting a little more popular and all of that. CMBS has had their moment in the sunlight at times, and then kind of, or spotlight, and then kind of faded away, came back, and we're definitely seeing some tightening within the CMBS market, tightening in a good way, tightening of spreads and tightening of underwriting, where they're willing to, on a park that had a lease up story, understand that story and not use a T12 of income, but rather go off of, use my rent roll as my income because I just leased up this park, and close with a T1 or a T2 or a T3. Debt yield is what drives the loan amount with CMBS more than anything else. So debt yield is a very simple calculation where it's your NOI divided by that required debt yield. CMBS, when they started lending in mobile home parks, back when I was a little kid, they probably were looking at 15 debt yield, a 15% debt yield on a mobile home park, because they didn't really like the asset class. They were kind of dipping their toes in the water, so to speak. So just to put into numbers, if you had a park that was throwing off $1 million in NOI a year, just to give big numbers, because CMBS likes big numbers anyway. So if you needed a 15% debt yield, that only gave you a loan amount of 6.666666667. So, kind of that's, today, if you go into CMBS, you're going to get depending on the quality and depending, like I just said before, on whether this is a complete cash out, keeping some land in the game, etc., some money in the game, there might be CMBS quotes today that are 8.25 debt yields or 8 debt yields. We're even starting to see some of those come across. It's important to be really careful of which CMBS shops you're using. There are some that are more egregious and some that are more prone to retrades, and are just trying to get you in the door. And the CMBS process, which we can discuss in another call, is a super, I would say, the most colonoscopy-ick type process. But so you have to be careful which lender you're going in the door with, because by the time you're done, if they come back and say, oh, whoops, our bad, it's not actually going to be an 8 debt yield, they need a 9 debt yield, that might be, something that is something to just be aware of. But we're definitely seeing some tightening in that space, and therefore for deals that primarily, refinances that you're looking to cash out on deals that you've improved, they can sometimes today come in more aggressive on proceeds than agency. They can give, 5-year deals, full term IO, and spreads have come in and debt yields have come down. So they're definitely something to look at and watch to see as they, get more aggressive within the market. I appreciate you having me, Michael. Really, always an honor and a pleasure. And if anyone needs to contact me directly, I know at times I'm hard to reach, so just shoot me a text. Typically, the easiest way to just get my attention and make sure that I either have myself or someone from my team get back to you. And as always, good luck out there. And 2026 is going to be everyone's year.
It's a big year. Thank you so much, Judah. As always, much appreciated for all the knowledge you share with this group. We'll be seeing you. I think the next one we have will be in April, with hopefully even more good news from rate cuts and hopefully spreads going down as well. So thanks again. Thanks everybody for joining. This will be recorded and inside the community if you want to take a look. And then it will also be available via podcast on the 30-day mobile home park, available anywhere you get podcasts. So talk soon, everybody. Thanks again, and have a good rest of your night. Bye.
Yeah.
Entrepreneurs make mistakes, but with the overwhelming amount of free information out there, you don't have to be doomed to make those same mistakes. You just have to find a consolidated version of the most important information. What if I told you that Ryan and I will gift you all of the due diligence mistakes that he and I have made over the years for free? What if I also told you that Ryan and I will hop on a 30-minute coaching call to walk through any questions you might have, give you advice, and even do a free live deal review to get you started on your first or next mobile home park acquisition? Just leave us a 5-star review, screenshot the review after it goes live, and click the link in the show notes to fill out the form and send it to us. Afterwards, join our Facebook group, Mobile Home Park Masterminds, where you'll find hundreds of other mobile home park owners sharing ideas, contractors, and deals. It's free to join, and we would absolutely love seeing you in there. Thanks for listening. Until next time, keep learning, keep growing, and we'll see you soon.